If you live in California and you're looking to get a reverse mortgage, then this is an extremely important video. I bet you didn't know this, but there are more reverse mortgages written in California than any other state across the country. And there's got to be a reason why, right? Well, there are 4 reasons why reverse mortgages are so popular and they do so many great things for seniors in California. So in the next, 30 minutes or so, we're going to go deep into these 4 reasons. You'll see me at my desktop in a couple seconds and we'll go through a PowerPoint and you will learn the advantages all about reverse mortgages in California and some of the things that you can do with reverse mortgages to help you in California that you can't do in any other state. So buckle up, get ready, and we'll be at the PowerPoint in 3, 2, 1. All right, so welcome to the PowerPoint, and like I just said, this is going to be an in-depth look into reverse mortgages in California in 2023. And some things have changed too, so you'll definitely, if you've looked into this before, maybe a year ago, maybe last year, you'll definitely want to stick around because there are some changes that have happened to the reverse mortgage program. As I see, most of it have been changes for the better. So the thing is, what we're really going to explain is why more seniors get reverse mortgages in California than in any other state. And there's 4 main reasons why. There's more, but I don't want to keep you on a PowerPoint for forever. So the first one is the credit line. The reverse mortgage line of credit grows at, it grows tax-free, and we're going to get into the weeds on it. We'll actually go over a client. In all these examples, we'll go over clients who have used these programs. But it is absolutely awesome to build your retirement safety net there. I don't think there's any other vehicle. Forget in housing, forget in reverse mortgages, just across the retirement landscape. The reverse mortgage credit line is absolutely amazing. Second, so number 2, this is unique to California and a couple of other states, but if you're looking at a reverse mortgage and you owe too much on your regular mortgage to do it, there is actually a hybrid reverse mortgage that'll still allow you to get a reverse, and we'll go into the details, but it is absolutely, it's improved folks' cash flow just drastically. So you want to stick around for that if you've looked into a reverse mortgage before and you've been turned down because you owe too much, or if you think you owe too much on your house to qualify for a reverse. Next, this is something called the LESA. So a number of my clients, once they understand how reverse mortgages work and how this LESA program works, they're actually using it to pay their property taxes and homeowners insurance for life. So with a typical reverse, you don't have to make a mortgage payment, but you are stuck with paying property taxes and homeowners insurance. This one, the reverse mortgage pays property taxes, homeowners insurance, and the mortgage. It's so beneficial. And again, it's just a massive cash flow play. Finally, or almost finally, sorry, I've got a frog in my throat, the reverse as a second mortgage. And think about, and you might be in this situation, a lot of folks who got their first mortgage within about 4 or 5 years, they've got an incredibly low interest rate, somewhere between about 2 and 4%. Well, a lot of times they're doing a reverse to just take care of debts, to pay off credit cards, to get some extra cash. So, but in a perfect world, they'd be able to do that and they'd be able to leave their first mortgage alone because the rate's so good and they're not really bothered paying it. So that is a real opportunity now, and this is a brand new program using the reverse as a second mortgage. So finally, at the end, this is something that if you're an old head, meaning if you've looked into reverses before, or if you followed this channel for a while, you'll understand if you can pass your house to your kids or not. But if you're new here, at the very end, we'll talk about that, and we'll also talk about the reasons why. And by the way, all of this information is California specific. So all of this is relevant to California, and all these programs are here in California, and you can take advantage of them here. So who am I? Real quick, probably for like 20 seconds. My name is Jason Eichmiller. I own Key Home Lending. I've been doing reverses and helping seniors since 2008. And since then, I've helped a little bit over 450 of them. That's my contact information below. If you want it, go ahead and just push pause on this video. You can write down, you can connect with me on my office line or my cell phone. Email me, jason@keyhomelending.com, or if you want to schedule a time to chat, you can go to www.reversequotes.com. Here are a couple reviews that I recently got from clients. They're actually friends. Mike got a reverse mortgage, and he recommended me over to his friend Oscar, who got a reverse mortgage. They're both in California, and they're just amazing to work with, wonderful people. I'm not going to read through these reviews either. I've got a bunch of them over on reversequotes.com, as well as interviews with seniors who have done reverses. But if you want to actually read these, then go ahead and push pause on this right now, and you can read into it, or again, go to reversequotes.com, and I've got a ton of them. Okay, before we go into reverses specifically in California, it's important to go over just the basics of what reverse mortgages are. And again, if you've been with me for a while, you understand this. This will only take about 45 seconds. But if you're new, you want to know what a reverse mortgage is. So basically what a reverse mortgage is it's a FHA program that's only for folks who are 55 and older, not 62 anymore. Well, the hecm is 62. Proprietary reverses, the hybrid reverse, and the second reverse are all 55 now, not 62. So basically, they allow seniors to take part of their home's value in tax-free cash without being required to make any sort of monthly mortgage payment. Although if you're not electing that LESA option that we just talked about briefly and we'll be touching later on, you do have to pay your property taxes and your homeowner's insurance. Anything that's owed on the house will have to be paid back. So if you owe, or will have to be paid off. So if you owe a mortgage, then we'll have to pay off your mortgage, and then we get you cash if you want the cash. So just word to the wise here. And of course, again, with the second reverse mortgage, it'll allow you to keep your low rate first mortgage. So with reverses, pretty obvious. The older you are, the more money you get. The younger you are, the less you get. You still own your home. You live there for as long as you want, and the house goes to your kiddies, your heirs in the end, and they can't owe any more than the house is worth. If they do owe more than it's worth, first of all, there's no reverse mortgage police that come and get them. They live there for the rest of their lives, and then their kids can give up they can say, hey, we don't want this, more so than it's worth, and the government will actually reimburse the lender, so we can't go after the kids. And they really are. Reverses are godsends for seniors who want to live in their home, but they either need some cash flow or they need a little bit of help with a retirement safety net. And yes, you can use a reverse to buy a home. You can use it to stay in your home. I actually have a purchase that's closing next week. So lots of seniors are using it to kind of downsize or right size. Other reasons why they use a reverse is to eliminate their mortgage payment, get rid of debt. I've got folks who have used it to fund their business, pay for home health care, help their grandkids, open up that line of credit that allows them to that gives them finally a safety net that actually grows. So if they need it down the line, then they've got more money than they had at this point in time. Bottom line is, if you can use some of your home equity to retire more comfortably and live a better retirement, then I'm happy. I know I did my job. So let's talk about the first of these four, the line of credit. So as it says here, boldly written, the reverse mortgage line of credit is a unique line of credit. It is guaranteed to grow tax-free as long as it's there and as long as you live in your house. And by the way, the reverse mortgage line of credit will be there forever. There's no draw periods or anything like that on it. You seriously can take it, set it up, forget about it. 20 years goes by, you can get the money if you need it then. So here's the deal. Here's why this is so important. So many seniors, they want to live in their homes the rest of their lives, but they're really worried that their money will run out before they do. And in fact, there's a study, Allianz, which is a kind of a financial advisor company. They did this study a few years back, and they found that more seniors are worried about running out of money while living than they are about dying. So this is a real concern, and you can kind of think about your situation, or if you're watching this for your parents, think about your parents' situation. It's very, very true. So when you look at Retirement, you're on fixed income, but you've got, what does the future hold? There's future expenses that might be out there. Well, obviously, you have inflation in this world. The cost of living is going through the roof. I mean, go to the grocery store, or go to the gas pump, and you'll see how much gas costs and see how much milk costs. But then also, what if you need home health care? You probably don't want to go to the nursing home. Who would? Nobody in their right mind does. So if you can, a lot of folks use a reverse line of credit when they're young to just set it up just in case something goes south on their health. And instead of going to the nursing home, they can finally use their home equity and a lot more than that in some cases to afford and pay for home health care. So yes, the economy, this inflation and increased cost of living, it's going on in this economy. Last year, this year, probably next year, we're still going to have crazy inflation. So just that, those are some reasons why the reverse mortgage line of credit is so popular. It does so much good. But instead of me telling you, let's look at Dave's story here. So Dave is 63. He's a widower. I'm like, widow? No, that's women. He's a widower. He has a $950,000 home, and he's free and clear. So he has no mortgage, no mortgage payment. But his fixed income is extremely low, and he has very little in savings and no investments. So Dave's biggest concern, because he lives pretty frugally, he is paycheck to paycheck with his Social Security. He had to take it at 62. He doesn't have a lot of clearance, but that's not a huge deal because he doesn't do a heck of a lot. But he's worried that if an emergency hits, then he's going to be, what do they say, SOL. Because he's only on Social Security, he couldn't ever qualify for like a home equity line of credit or anything like that. And he's also looking towards his future, and he was concerned. He has some sicknesses in his family, and he just wants to make sure that if something happens to him, he'll be able to live in his home. And I don't know, it might sound morbid, but it's true. He wants to die in his home. So that's kind of his situation. So, excuse me. We set up the line of credit specifically just to give Dave a retirement safety net. Sure, we could have given him some monthly income as well, but he didn't want it. He said he was doing fine. He just wanted as much in the line of credit as he could get. So off this $950,000 house, he was able to get a $298,000 line of credit. Every year it's going to grow, and it doubles every 10 years or so. And yes, Dave does sleep very well at night knowing that he's going to be okay. But check this out. I'm going to show you a line of credit amortization table. So you can see, this is me circling it to see how unsteady my lines are. But if you can see end of year projections, the line of credit starts at $298,000. After 10 years, it's $590, so just about doubles. 20 years, it's 1.17 or so. 30 years when he's 93, if he hasn't taken anything. I mean, it's his money. I've told him, like, if you need money, take it. And of course, if he takes money, let's say he takes $50,000 out, that just decreases the line of credit by $50,000. But year 30, if he didn't take anything, he's got $2.3 million sitting there. No interest is being charged. The thing is just growing, getting bigger every single year. Then when he takes that 2.3, because it's not income, technically he's borrowing it because it does have to get paid back when he passes away or sells the house. Then that money is tax-free. So he can write himself a $2.3 million check. Now, I will say with these numbers, it is based on the current interest rates. So the line of credit growth will go up when rates go up, and it will go down when rates go down. So that will impact the numbers growing. But you can't project that. That'd be kind of impossible to do in a projection. So just suffice to say, when he's in his 90s, he'll have somewhere around between $2 and $3 million to play with, again, if he didn't take anything out of it. So what are some takeaways from the line of credit? Well, obviously we know that your home value has increased just drastically, but your expenses have too. And fixed income makes it, yes, we know fixed income makes it really tough to survive. But beyond that, if you're retiring, you need to have a retirement safety net. And if you don't have a lot of investments and if you don't have a lot in savings, then use this line of credit. No interest charged until you take the money. And the thing more important than that, because you don't, as long as you live in your house, you don't have to pay it. You're going to have growth and more growth and more growth, and it's all compounding. So again, if you go back, leave this up here for a second so you can pause it. Oops. Look at this. Pause this. Look at that line of credit growth. It's it's awesome. So that's the line of credit. Next, let's talk about the hybrid reverse mortgage. What if you owe too much on your house to get a traditional reverse mortgage? You either tried and they've said, hey, sorry, you'd have to come to the table with funds, or you're just eyeballing it and you think, you know what, I want to get this, but I think I owe too much. First of all, you can always call me and I can go over the numbers with you. But there is, if I go over the numbers and say, hey, I'm sorry, I'd love to help, but you do owe more than, or you owe more than you, too much to get a traditional reverse mortgage, but you still need payment relief. You're still kind of, you might be on fixed income or you might be looking to retire and you need to get your cash flow under control. So herein lies the hybrid reverse mortgage. So let's talk about Mike and Cindy real quick. Mike is retired and Cindy's still working for now, but she doesn't want to for long. She wants to stop. And right now she can't stop because it was just with her mortgage payment and her bills, it's just too much. So just like a lot of folks that I've helped, she applied for a reverse or helped with this hybrid program. Cindy and Mike, they applied for the reverse, but they couldn't qualify because they owed too much to qualify. So, by the way, their home value is 870 and they owed 379. And the traditional reverse mortgage, the regular old hecm, was $52,000 short. So to get a regular reverse, they would have had to pay a check or write a check out for $52,000, and they could not do that. So on top of that, they had $20,000 in high interest credit cards. If you look at the interest on your credit card statement, high interest credit cards, that interest is in the 20s. So not only were they paying their mortgage, but they also had to deal with these darn credit cards. And at the rate they were going, they were just never going to pay the thing off. So fast forward, no drama here, no dramatics. Did it work? Well, I'm using it as an example. Of course it worked. This hybrid reverse paid off Mike's and Cindy's $379,000 mortgage and gave them $25,000 to pay off the credit cards. So they even ended up with a couple of G's and $5,000 in their pocket. Not going to change the world, but hey, $5,000 is $5,000. Couple that with not paying credit cards anymore and not having to make a mortgage payment anymore. That's pretty neat. So, how did this program work though? Let's look at this program under the hood. So with this hybrid reverse, what it basically does, it has Mike and Cindy, or you will make a mortgage payment for the first 10 years of the loan. But the mortgage payment is extremely low. So if you look at, this is a $410,000 loan, Mike and Cindy are paying $1,316.85 a month. If you compare, I don't have it in my notes, I forget, I should have had how much their credit card payments were and how much their mortgage payment was, but they've saved thousands of dollars because suddenly they're not paying principal and interest and suddenly they're not paying the credit cards anymore. And they got $5,000 extra too. So first 10 years, they pay just a tiny, tiny amount on the mortgage. And after 10 years, this loan automatically, without you doing anything, the loan automatically converts to a reverse mortgage. Of course, with a reverse, they go from that $1,316 a month to $0 a month. Although, of course, we all know it, they still have to continue paying property taxes and homeowners insurance. On top of that, they're fine paying $1,316 a month. They're happy doing it. They're okay. But in the back of their head, they always wanted a reverse. So if the economy improves and their house starts to appreciate or interest rates go down, then we can always just flip this sucker into a regular reverse mortgage down the line anyway in the first 10 years. After the 10 years, they're kind of home free. But again, if their house is worth drastically more, then it might make sense to refinance them into a new reverse mortgage. So you just never know, and you always want to like I always tell my clients, if you have any questions or if you think anything, just ask me. We'll see if you qualify. We'll see if you can flip this thing. We'll see what your options are. And I never like to assume. I'm pretty smart. I've done this for since 2008, helped a ton of people, but I'll never say that I'm smarter than the computer who tells the computer tells us how much you can get. So who this hybrid reverse mortgage works for? This is an amazing program for folks who definitely need cash flow relief, but they just again they owe too much to get a reverse. So if you do the numbers and it looks like that, hey, you'll be able to make it making a minimum payment for 10 years, then it makes sense. So second, if you're still working, you have a pretty big mortgage payment, you know you've got to do something about it in order to be financially stable when you retire. So if you're working and you know you're doing okay now, but you know when you retire, you're not going to be doing okay, then this is a good proactive tool. Finally, if you have other expenses like credit cards or business expenses or anything else, maybe you're looking to buy a small property or invest into something. This is really smart. As you can see, it just the slide cut off. I don't know what I was doing there. I'm an expert at reverse mortgages, not so much building slides. So how can you qualify? So first of all, you don't have to be 62. You can be 55 or older. The loan sizes are from $100,000 up to $4 million. So as little as 100 all the way up to 4 mil, depending on your house value. Yes, the older you are, the more you qualify for. The younger you are, the less you qualify for. We do look at income and credit, just like with any of these, but we are very loose on it. We just want to make sure that the income's enough to really cover your debts and your credit. Well, you haven't been a disaster over the past couple of years. Obviously, if I went over all income and credit situations, we'd be here for 3 days. So just give me a shout and glad to go over your exact situation. One thing you do need to know for this program is you must have at least 10 years of mortgage payments remaining to get this. Okay, so that is the hybrid reverse. So if you've got a decently high balance on your mortgage and you want to see if you have an option and you can do it, then give me a shout and we can see if this is a solution for you. But it's an amazing program. So next, let's talk about how a reverse can pay property taxes and homeowners insurance for the rest of your life. Now, this is something that works extremely, extremely well in California. In fact, and again, the program's called a LESA. This is one where I do for probably maybe just about half of my clients in California. Because again, if you're looking at cash flow and your property taxes and homeowners insurance are kind of hurting a little bit, then hey, might as well have the mortgage company pay for it and you don't have to. So let's take a look at two of my favorite clients, Mel and Leo. So Leo actually just turned 90 and Mel's a couple years behind. They're in Sylmar, and the whole reason for doing this is, and by the way, this is a standard reverse mortgage, just where we're going to use it to pay off their mortgage and pay off their property taxes. So Leo has cancer. He's just a heck of a guy. He's such a great guy, and he just had so many expenses, and his cancer meds were just absolutely through the darn roof. Just it was too much to pay if you were working, if you weren't retired. But he's on fixed income, and it obviously wasn't enough. Their home appraised for 770, and they owed 362 on it. So what did we do for Mel and Leo? So we paid off their mortgage, obviously, so they cash flow better with that. Then we gave them $31,000 extra for their retirement safety net. So They have that 31,000 in that line of credit that we were talking about earlier. Then, this is what's really neat about their situation. We set up a side fund, side escrow account, to pay property taxes and homeowners insurance through Mel's. Leo's older, so I'm not worried about him. We set it up to pay taxes and insurance through the rest of Mel's life expectancy. Now, by doing all of that, number one, they've got the retirement safety net, but again, we spoke more about that when we talked about the line of credit. But their cash flow, by not having to pay the mortgage and now not having to pay their homeowners insurance and property taxes, Leo can afford his cancer meds, and they're doing all right. They're not in the lap of luxury. Medicine's expensive, but they're doing okay, and they're in the house. They're in the home that they love. So again, favorite clients, wonderful salt of the earth people, and I'm so glad this program was there to really to help them. Whew! I didn't put you to sleep yet, did I? We're more than halfway through. And so, by the way, you can tell this is longer than most of the videos that I do, and probably everything that you see on YouTube about reverse mortgages. But I wanted you to really understand these programs and see that, like, hey, I'm in California. These are the programs that are available to me. This is what I can. Inquire about. So I've always believed in too much information. While sometimes this stuff is kind of dry, I still think having as much information at your fingertips is good, is smart. So bear with me if you're enjoying this. I hope you are. If you are enjoying it, if you don't mind liking the video, subscribing if you aren't subscribed, I'd appreciate it. And then that way you can get notified when we have other videos about reverse mortgages as they kind of come up. So, oh, and if you have any questions, you can feel free to reach out to me. Obviously, you've got my contact information, or you can always type them below, and I'll be glad to answer them. So, how about, what if you have a low rate first mortgage? Now we're talking about the reverse as a second mortgage. So, what if you have a low rate first mortgage and you want to get a reverse because you've got other bills to pay, but you're okay with making that 2 to 4% payment, right? You're okay with making that payment, and you just want to use the reverse to tackle your other bills. Well, California is one of those few states where this program is available. And it's a second mortgage, and it's saved some folks' hides. So here's the deal. Outside of the regular mortgage, and again, our rates are so low, but if you're bringing in a decent amount of money, if it's not impacting your cash flow, so many seniors need extra cash to pay off their credit cards. I mean, credit card, again, if you don't have a 0 or low percent credit card, which most people don't, then you know where those interest rates are, and they're not pretty. You've got debt. For some seniors, they're looking at home health care, paying for that, home improvements so they can age in place, buying something, helping, like a car. I have a lot of folks whose cars are run down, who get reverses to buy an affordable car, and I try to stress affordable because we're not trying to live in the lap of luxury here. We just want to be comfortable. Oh, of course, then you can always help your grandkids, help your family members as well. It's another reason why seniors looking for additional cash. But you don't want, as I just touched on, you don't want to eliminate your low interest mortgage. You don't want to get into an adjustable rate HELOC where if the rates go up, your rates are massive and you got to make the payments. And you don't want to be forced into more monthly payments while you're on fixed income. Thus, the reason for the reverse second mortgage. So let's talk about Susan real quick. Susan, she is 72 and she's a widow, just like Dave. She has a $1.3 million home and she has a $250,000 mortgage. Her interest rate's just 3.5%. It's pretty good. She doesn't have a problem with it. She doesn't want to pay it off. But she's got these high interest credit cards and she wants some extra cash to fix up her home. She's got a pension. She's got Social Security. Again, she's okay with paying the mortgage. She just needs help with the credit cards and to fix her home. So, again, with the second reverse, we left her first mortgage alone. Then she got 178,700 buckarooskies to pay her credit cards and to remodel her home. Susan's going to live in her house the rest of her life, just like so many of my clients, and she wants to. I don't blame her. She wants the house to be very comfortable for her. So thus, I mean, credit cards are gone. Obviously, that's an expense, but remodeling her home, I mean, it's great for her. Now, just like any other reverse, she doesn't have to make principal or interest, so she doesn't make mortgage payments, but she will continue to pay property taxes and homeowners insurance. And that was fine for her. It wasn't a big deal. And by the way, there are no LESA escrow account options with the second reverse. It's just with the traditional first reverse. So, other thing is that her second reverse, she doesn't have to worry about it adjusting all over the place because it, unlike all these HELOCs, the second reverse has a fixed rate. Bottom line, right? She's financially okay. The weight of her credit cards is off her shoulders, and her house, well, they're doing the work now, but once the work's done, her house is going to be very, very comfortable for Susan. So, details. All right. No mortgage, no monthly mortgage payment, just like a traditional reverse. Again, she has to pay taxes, homeowners insurance, HOA. She can keep actually with a second reverse. You have to have a first mortgage to qualify, and of course you're keeping it. Age is 55 plus. It's a fixed interest rate. The older you are, the more cash you get, just like any other reverse mortgage. No mortgage insurance charged, and it's non-recourse, meaning if you end up owing more than the house is worth, we're not sweating it. So the government goes and pays it off. So, do we want to talk about D? Yes, let's talk about D. I know we're getting pretty far off in this. We're 30 minutes in, but let's talk about another example of using home equity to create a retirement safety net. So real quick, D, she's 67, another widow. I don't know, these widows like me. She lives in Oceanside. She's drawing down her assets, and because her husband didn't have any life insurance, and her fixed income isn't enough. She was drawing almost $3,500 for her investments every month. Her house is worth 2.1, and she owes 569. She wants to reimburse her investment accounts from all the money she took after James passed. So that's Dee's situation. She's burning through her money. So what happened is we paid off her $569,000 mortgage, which saved her over $3,000 a month. Then we gave her almost $315,000 in cash. She's going to use some of it to reimburse her investment account, but also at this time in the market, her financial advisor told her to kind of like hold off and keep it in a high interest savings account. But either way, her financial advisor projects that she's financially stable. She's going to be okay for the rest of her life. Living frugally as she's got it. Again, she can't live in the lap of luxury. She can go out a little bit now, though. She can enjoy her life, but she's going to be okay. And again, just like Dave, just like everybody else, Dee is sleeping well at night. She's doing okay. She's going to be okay during retirement, which is the most important thing for me. It's like, what can I do through this program to help your retirement, to help you live easier? So it's funny, after all these changes with reverses, CPAs and financial advisors and attorneys, they're now recommending reverse mortgages to stop drawing down on your assets, just like D, right? Stop taking out of your investments. Use it as a line of credit. Get that extra branch on your retirement money tree. And when the market is down, your retirement savings just last longer. So this is, obviously everybody has a different situation, but if you're concerned that you don't have enough money in your assets, or you're taking it too fast, or your cash flow is just struggling, then a reverse is, again, I see it because I do it, help so many seniors for these reasons. It's a godsend. So here's a secret. It's not a secret. I don't know why I put it as a secret. How you can get a reverse mortgage and still pass your home down to your kids. So many people think, even though financial advisors now understand them, CPAs understand them for the most part, but people still think that you get some money with a reverse and then the bank gets the house. And that's not true. So here's how this works. So with a reverse, some details. A reverse is just a lien. It's just a mortgage, just like anything else that's liened on your house, like a regular mortgage or a HELOC or a second mortgage. You still have full ownership of your home. You can sell it, pay it back, or refinance it at any time. Note for you to know is if this is your primary residence, which it has to be for a reverse, you can't have a prepayment penalty, meaning you can pay this thing down or off at any point in time. Once you pass away, your house goes to your kids, your heirs. Whatever's owed at that time gets paid back, and your kids get the rest. And by the way, you'll get a mortgage statement every single month from the reverse mortgage company telling you how much you owe, and then if you have a line of credit, how much money is available in the line of credit. And with the line of credit, you'll actually, month by month, you'll see it get bigger and bigger. Remember that. That amortization schedule I showed you a while back. And of course, if too much is owed on the house, if more is owed on it than the house is worth, let's say you have the reverse forever, let's say the market absolutely tanks, right? Goes down the toilet, as they say. If you owe more than the house is worth, nothing can happen to you. Nobody can ask for the money back as long as you still keep the house as your primary residence and pay the property charges, or have a LESA and have the property charges paid for you. And then when you pass away, if more is owed on the house than it's worth, your kids aren't going to want it. They say, wait a minute, why do I want to pay for this thing? I don't want it. So they'll just give it back to the lender, they'll take it, and the federal government, or depending on the program, the lender, either way, the government or the lender is required by law to pay the thing back. So it can't possibly hurt your kids, which is amazing. So we had this slide before. But we know that home values have increased at a ridiculous amount. Everybody has equity, but everybody's expenses are so high now. And not only does fixed income make it tough to survive, but if you're running through your retirement accounts, then that's kind of a double whammy where you're seeing your money disappear. If you remember to the study we talked about briefly earlier in this, there's that study by Allianz that stated, as you know, way more seniors are worried about running out of money while they're still alive in retirement than dying. Because when you're alive, you got to pay for stuff, and you have a lifestyle, and you have a house, and you have your grocery bill. If you run out of money, you run out of money. So that is why reverses are so heavily utilized, and that's why they're so important. And if you own your house and you have equity in it, then it's such an important part, at least something to consider and something to look at. So I'll leave you with this. This is Teresa. She was a client about a year and a half ago, but she still keeps in touch. And she was a widow. I guess she is a widow, not was a widow. And she was having a tough time, and she used a reverse just to really to live more comfortably and to kind of get her feet back on the ground. So the reverse was a tool. That's all it was. For her, for you, for anyone, it's just a tool. It's just a mortgage that allows you to take some of the cash out of your house. But the things that you can do with this cash and the options that you have with the reverse, they can really, I don't want to be too dramatic here, but I will be. This can be a retirement game changer. And I've witnessed so many of my clients absolutely change the trajectory of their retirement by using a reverse. All right, that's it out of me. My name is Jason. Again, you see me here. If you need me, if you have any questions at all, feel free to reach out. It's my direct line, 888-309-9705. You can email me, jason@keyhomelending.com. or if you want to schedule a time to chat, or see kind of like how other seniors feel about reverses and feel about having, after having worked with me, then go to www.reversequotes.com. All right, thank you. This has been a little bit longer than expected. It's about 40 minutes, so I'll leave you here. But again, my goal was to go deep into this, not just give you highlights, but I want you to truly understand what your options are so you can look at this intelligently and say, like, okay, here's what I need, here's what I don't need. I should do this, or I should look into this, or I should not. All right, that's it for me. If you do need help, if you want my opinion, if you want to ask me some questions, I'd be glad to. And I'll tell you this, I'll do my absolute very best for you. All right, that's it. Take care of yourself.